Alright, so the section we're in section 4, we're in 4.9 and 4.8 technically, that's where we're at. We're on insuring a mortgage. That's kind of what the section we're in. So section 4.8. Hey, will you stop talking? Alright, we're doing mortgage insurance.
Knock it off.
So, mortgage insurance. The big thing today, what I want to go through. Number one, I want to do a quick calculation of how to calculate mortgage using a chart. I know that we've already done mortgages. We had that big crazy formula that I've done previously with you when we had other percents. But the reason why I brought this one back up is because they give you charts for insurances. It's kind of nice to see a chart for mortgage because your bank will provide this. In fact, my bank, when they provided this, they didn't give me this chart. They gave me the second chart that I had. It's almost the exact chart, but it had more numbers on it. So let's do a quick example of this. And then the second part is we'll pick a different term. Okay, then the second type is we're going to change the term length. And we'll do another calculation with that. Once we're through those examples, then we got to get to the insurances. We'll talk about coverage in terms of death, and then we'll also talk about instead of death insurance, like mortality rate, we'll talk about what happens in case of like a natural disaster, a fire, that type of thing. So we'll talk about all the different classes of insurance, or types of insurance that you can find. All right. So first one, this is the first example I'd like to write down. I'm only going to do a few of them today. Hopefully this makes sense. Let's pick one of these numbers. So, Dustin, I'll give you the option here. Pick any of the amounts from $40,000 up to $110,000.
40.
$40,000. Okay. So we're going a $40,000 home. Okay. Yep. We're going 30-year term because that's this first chart is always based on 30 years. Okay. Let's go to the next group, ladies over here. Pick any percent you want for your house for the mortgage.
Cheap. 7.5.
7.5. All right, we're going cheap. All right, so here's the ones we're picking. What this number is on your chart, where we picked the 40,000, we picked the 7.5% interest. 7.5% interest. What this is that number on that chart is your monthly payment. So this is a $280 payment. That's what the chart's telling me. And that's going to be for 30 years, for 12 months of a year for 30 years. So what they're going to want you to calculate first is what did you totally pay for the home in 30 years. So now that we read the chart, they gave you this type of information. We find, the 280 bucks. We're going to take that times 12 times 30. It's important. We got to figure out what we're paying total.
Not this again.
Back, all right. Oh, it shrunk. That's weird. It did get smaller, right?
Yeah. Yes.
Yeah, it's close enough. All right. That was weird.
Okay.
All right. So, anyways, we take the 280, your monthly payment that we just found. Again, that was this number right here. We're taking that times 12 times 30. Whatever this number is, that is your total you're paying the bank back in 30 years. What was the number we had?
100,800.
100,800.
Yep.
Okay, so pretty nice. There you go. There's your home that you're paying in 30 years, paying 100 grand, more than double. But what the book will ask is, okay, find your total payment. Here it is. Boom. That's your total pay. But what it will also do is how much interest did you pay the bank? What was the extra charge you paid the bank? Well, your loan was for 40 grand, right? That was what your house that you're borrowing. So all you have to do is subtract 40,000, and this will give you what you paid extra for your house. Well, that should be 60,800. And what this is the interest paid to the bank. Okay, it's a lot. I know that's a really tough thing to look at. You're like, oh my gosh, you're paying like more than double for your home. Yeah, that's normal. You're going to do that for your student loan. You're going to do that for a credit card if you have one. Like that's a normal everyday occurrence. That's, believe it or not, they use the same formula for credit cards and student loans. I did a calculation of what my student loan was. It was outrageous what I'm paying back for what I borrowed originally. Unless you can pay it off earlier. Okay, questions on the first type of problem that you're gonna have. Does everyone understand what they're gonna give you? This is the problem in the book. They're gonna give, you have to go find this number from the chart. The chart's on the page right in front of your homework. You multiply and you figure out what your final number is. I wanna see all of that work. I wanna see this and what you subtracted. Okay, use calculators, it's pretty easy. Question?
Are we always multiplying by 12?
Yeah, because on those first problems, they tell you have to go for 30 years, so you have to go 12 months a year for 30 years. Yep, good question. Anyone else? That was good though. Okay, second problem today. Second parts. I wish this would work. All right, second problem. Let me get rid of this now. Okay, this one is, it's not more difficult, it's just different. So, does anyone still need that though? Okay, moving on. Okay, next problem here. I'll pick next group. Pick any year term for your house. You can go 15 up to 40.
35.
All right, 25, 35, which one?
35.
35.
35, we're going 35, sorry. I went 35. All right, we're going 35. Okay, 35-year loan. Okay, percent. Let's go to the back group. Gentlemen, back here.
Yes.
Give me a percent from the board. One of
10.
those. 10? Okay, we're going 10%. All right. All right, 35-year term. This is my interest. Okay, now, what this is gonna be, the next type of problem you're gonna have, I think 3 or 4 of these, where they're gonna give you a price on the house. So let's say you're gonna be purchasing a $92,000, $500 home, $92,500. Okay, that's your purchase loan agreement. That's your purchase price. Or the loan that you're taking, okay? All right, what they're gonna ask you to do is calculate what your total pay to the bank will be after 35 years. It's the same idea you just did. The only difference here is we're using a different number of years. Okay, so we have a certain percent, we have a different number of years. So these numbers could be way bigger, way smaller. Because now it's not just 30 years every time, it's whatever number they said. So we're doing the 35 and we're doing 10. So this is the number we have to be looking at, is that number right there.
Well, you get 39,500.
They'll give you the price of the home. So $92,500. They'll say maybe one of the homes is 35 grand. Maybe one of the homes is 150 grand. They'll give you different prices on homes. Question?
I have to leave.
Okay. Check the video online. We have homework.
Alright.
Okay.
Bye now.
All right.
See you later.
So 92,500. 35-year term at 10%. Here's what I want you to do. From this chart, what this is, you have to figure out of 92,500, divide this number by 1,000. Why do you want to do that? What this chart is giving you is the price you're going to pay per $1,000 for your monthly payment. This is your monthly payments, right? So when I divide this by 1,000, here's the trick. You move this decimal back 3 spots. So that's 92.5 is that's your price of your home divided by 1,000, because they said this chart's out of per thousands. And what you're going to do is you're going to take this number and take it times the number that's on the chart. That's the 8.6. What this is going to give you is it will give you your monthly payment. Does everyone see how that works? Because what they're asking you to do is figure out how many thousands of dollars you borrowed. I borrowed 92.5 thousands of dollars. Take it times 8.6, and that is what your monthly payment's going to be. So, to do my monthly payments, I'm going to use my calculator here. No, it's right over here. All right. So, I took $92,500 divided by 1,000. I take 92.5, and I take it times 8.6 for my chart. It looks like my monthly payment, 795.5.
Yeah.
Okay, that is my monthly payment. Now, what they're gonna also ask you to do is figure out what you're gonna pay for that home in total. So now that we know that we borrowed $92,500, and this is our monthly payment, you have to take that number times 12. Times 12, because 12 months a year, and then how many years did we go? Well, we went 35 years. So my end total, what I'm gonna pay for that home is times 12 times 35. I'm paying 334 grand for that home.
That's more like.
That's a lot of extra money that you just paid for a loan that was supposed to be 92,000 in the first place. Okay, that's, the trick is what I'm worried about is that a lot of people will not understand how to get to this first number. Whatever the price of the home you get, you have to divide by 1,000. They even tell you that in the chart. Divide by 1,000 per 1,000. Then you take it times whatever the number is on the chart that matches it. That's your monthly payment. The reason why they do this, they want you to be able to calculate different numbers at different times of the year. So like if you're going 20 years or 25 years or maybe 40 years, most banks don't go past 30 unless you have a really, really expensive home. They won't go past 30. Or if you're really young, they might. All right, questions at all about how I calculated that? Okay, all right. Third type of question today. Third type. Okay, this is my third type. This is the next one we're gonna have. Okay, I'll let you write this down. Let me restart the camera here so we have everything recorded. Okay, so second one here. So let's say we're on a 25-year mortgage. I know that a lot of you want to do a 25-year earlier. All right, so okay, so we're going to be on a 25-year mortgage. That's the one that a lot of people wanted earlier. And let's say the price of your home, they're going to give you that. Let's say the price of your home is $115,000. Okay, so that's the price of my home. And we're going to go a 25-year mortgage, 25-year term. And what they're going to say is that somehow the person that was on the lease, or I should say the loan, the mortgage, died in year, let's say it died in year 10. So there was a death in year 10. And they want to know what will the insurance cover for the rest of that loan. So what you have to do is you have to figure out from these two numbers what number is on the chart. So we're going 25 years and we're going the 10 year where the policy covers. So what the insurance company will give you is they'll cut you a check for 77% of what your loan is. So $115,000, you're going to take it times 77%. That's 77% as a decimal. And this is what the check will be given to you to pay off that mortgage. If you have this coverage, this mortality coverage, death coverage. So 115, 000 times 0.77. It's an $88,000 insurance policy.
And they give you that one that team.
Yep. They'll automatically write that check to the bank after your death certificate comes in and everything, and now your house is paid off. So it covers the rest of it. As long as you were making your payments. The worst part would be you lapsed in a couple payments, you're behind, and they only cut you a check for that percent, and you still have to cover the difference. Well, that's not too bad. You only have a couple more payments to go, but if you're not the person that makes money in the house, you need to find that difference so you can pay it off. Now, this will not cover your property tax. It won't cover anything else. It basically covers home. That's what this is going to cover.
And that's for when who dies?
That's when somebody who's on the actual loan agreement, like that signed it for the loan, the mortgage, passes away.
So if it was like three people living in the same home, like three friends and one of them dies.
Whoever was on the agreement. Whoever was on the agreement. So let's say that you had three people living in a home, but the one person that had the mortgage, that took out the mortgage,
So the one that pretty much bought the house.
yeah, the one that bought the house didn't, like they didn't die, but if one of the friends did, nothing covers that. So
what if like one of your friends, like when you bought the house, died?
then it's covered.
For the two other people that live in it.
Yeah, because they're on the, it's any one person that was on that agreement died. Yeah. That's what you pay insurance for.
And how much time do you pay for that?
Yeah. Yeah, so the idea is the minute you take out your loan, you're automatically paying insurance on top of it. Home insurance is not very expensive. I think for mine, for covering my cars, my house, and then some of the items, because you can insure certain items in the house that they're worth more money. I think mine was like $100 a month for coverage,
And that's plus like.
plus the mortgage. Yeah, plus the rent. But it's not bad. It's not like super crazy expensive, but it's something you have to think about. All right, questions on what we did there with the mortality? Okay, that number is usually pretty straightforward. You're just taking whatever the year is, the term, and you're gonna multiply it. But remember, you have to change that number to a decimal. Don't take 77 times that. Okay, all right, last problem of the day. This is one that we didn't get to yesterday. Last problem.
Under a big tree.
Gentlemen, can we stop talking, please? Thank you. All right. All right, this is one that yesterday the projector cut out. This is one where, depends on the area you live, so they have areas A, B, C, and D. Could be your insurance coverage. Maybe there's certain insurance rates that happen in the home that you live. So like maybe area A is a normal neighborhood, typical neighborhood. Area B would be a high crime rate area. C would be anything where you're in like a, let's say a natural disaster area where you have to cover flooding or earthquake. And then D would be any unnatural like weather phenomena or like a fire or anything else. So it'd be anything else that you couldn't foresee happening that would be what they consider like an act of God. Like our, like with level C, maybe this is like hurricanes and earthquakes. But down here, this could be anything like you're in a wood environment and there was a forest fire. That type of thing. Like that's something you can't predict. It's not something that would happen regularly. It's not a weather phenomenon that you have to be prepared for. An act of God. There's certain insurance companies that they consider a hurricane that level D, as opposed to flooding would be level C. So it just depends what you have. So let's say you're living in a level C area where maybe you have to deal with tornadoes every now and then, where it's a regular occurrence. They know that you're gonna have tornadoes in that area. So you're level C, and your home is a $92,500 home, the one home that we purchased earlier. Okay. And let's say it's made out of wood. It's a wood frame house. It's a wood frame house. Okay? By knowing what level you are and what your house is made out of, the policy will automatically tell you what your insurance is per month, the coverage rate. So what that 0.444% is, that's your coverage for that month. So the idea this is what the policy would be. You take the $92,500 and you take it times that percent. That percent is this. It's 0.00444. That's, a quarter or almost a half of a percent. It's not very high, because remember, whatever your percent is, you have to move the decimal over 2 spots. So it's even smaller. And what this is, the 92,500 times 0.004444. Okay, we have $410 payment. So maybe your insurance coverage, like this is a pretty big number. Some people, maybe that's your annual coverage, maybe that's your monthly coverage. It just depends on what area you live in. This could be a monthly coverage. Maybe they charge you that per month. I know that when I talked about it yesterday when I was looking at a house in Clear Lake, the insurance for the flood area by the South Shore Donut area, the insurance was crazy high. It was more than my mortgage was going to be, which was stupid. So it was like, that was an area like we looked at a home there and we're like, we can't even afford this stupid flood insurance. And it wasn't like we were predicting there was a flood. It just, we had to be covered for it because that area was in that, that level C area where it had a higher percent rate of flooding. So it was one of those things you just had to cover. And some of these percents look bigger than others, but it could be that maybe that's what you get charged per month as opposed to per year. There could be a clear difference there. Yeah, so it's just one of those things you have to have insurance on when you're taking a loan. I know like when you buy a car for the first time and you have a loan for a car, you have to have full coverage. That's the law in Iowa. You have to have full coverage on a car that you have a loan on. You have to have full coverage on a vehicle if it's on a lease. What I mean by that, or not a lease coverage, but I'm talking about if you have a lien against the vehicle. So for instance, I did this a long time ago when I was just in college. I bought a snowmobile, and I used my car as a part of the not down payment, but as a lien. So what that means is that they look at the value of my car, and they say, okay, we're going to approve you for this loan because your car is worth more than the thing you're taking a loan out on. And if you default on the payment, we take the car. So I was basically gambling my car that I can make payments, and I did that because it lowered my interest rate on the loan that I was taking, and I knew I was going to pay it off anyway. So it lowered the interest rate, and I didn't have to have a cosigner because I had a vehicle that could cover it. That's scary for some people, but that can bring down your insurance rates too. But I did have to have full coverage on the vehicle because I had a lien against it. So even though I took out a loan for a snowmobile and I had to have coverage on that, I had to also have full coverage on the car that I had the lien against. And so that I didn't predict that, but it makes sense. The car has to be covered in case they need to collect it. It needs to be worth what it's valued at. All right. Questions at all about the 4 types of problems I covered today? All right, here's your homework today. It's over 4 different pages. It's going to be due on it's Tuesday. This is going to be due on Friday this week. Due Friday, so you have a couple days to work on it. Due Friday. Page 89. Now I'm going to have a couple different pages here, because I picked basically a couple different problems from each page. So the first one is 1 through 3, exercise B. Exercise B on page 89 is at the bottom of the page. Be careful of that. Page 91, 1 through 5, exercise A. Those are, I think, are at the top of the page. Page 103, numbers 1 through 3 and number 7. Exercise A, those are at the top of the page. And then page 105, 4 through 7. And that's exercise A. And that's at, I think, the bottom of the page because there's a big chart on top of it. This stuff is going to be the insurance, like what you're seeing here with the different frames, the different areas, I mean. 103 is the death coverage. Page 191 is if they give you a different term, like 25-year term or 20-year term. And you have to calculate what you paid for that house in total. And page 89 is figure out the mortgage, what you paid the bank and total interest paid the bank for a 30-year loan. So that's, I've kind of broken them up over multiple pages. This is due on Friday. Take your time on this. Take a calculator. It should be really easy. Like you shouldn't need to do a lot of extra like problems and searching and how to do it and stuff. But yeah. Try to get to work on that because it's due Friday. So, all right. Question? Yes. Yes. Okay, I'm going to put that first chart up here. So if you're going to that first chart, here it is. This is like the page 89 stuff. Hold on.
Ow.
Here's page 89's chart you're going to be using. It's on the page right before it. You'll see it. So this is the chart they're using on the first page.
No, just the first one. Yeah, you're not supposed to get that. I got mine out of time. Good job, I got 8 out.
So like the 89 is the one where you have to take it divided by 1,000?
No, that's the second one. That's page 91 stuff. 89 is you have to figure out where your price of your house, what the percent was, that's your monthly payment, take it times 12, times 30. Figure out how much extra you paid. Yes.
Find how much extra you paid?
Yeah, so it's like you're doing this number, let's say you're buying this home, 100 grand home at 12%. So you have to take this number times 12 times 30.
Yeah, but it's just you find monthly payments.
Yeah, monthly payments, we found it.
Okay.
And then you have to figure out what your total cost is, because you're doing exercise B at the bottom.
Oh, alright.
Yeah, hey, make sure on the first page you're doing exercise B's at the bottom. Because they want you to figure out what you paid total, and what was the extra you paid in interest.
Yeah, 40,000 times 10%, times 30. Then you get your total, and then subtract that from the. 0.1, or the other one. Times 40.
You're saying something really solid.
What was that?
You guys listen to some messed up music.
You listen to sad, but that's in the moment.
At 10%, yep, it's 351. You have to take it times 12, times 30. Figure out what you pay total. And then that's your total payment. And then you have to subtract it from the 40 to figure out what you pay the bank the next one.
So the amount paid would be the times.
Yeah.
You missed your first one. The best thing.
Mr. Warren. Maybe we-
That's Smith.
You got another one. You gotta drop back to other
Breads.
Did you compute it back up too? Because I believe those are digits.
Blackout.
What the heck?
Yes?
Number one, number 13.
Yes.
I'm gonna feel.
So they're giving you your house, they give you your percent.
Okay.
You gotta go find that number, let's say it's 60,000 at 10.5, so that's your number. That's what your monthly payment is. So what you have to do is take that times 12, figure out what your yearly pay is, take it times 30, because you want 30 years, and that's what you pay total for your home. Then the last step you have to do is subtract it from the loan you took out, figure out how much extra you pay the bank. You just subtract what the house was worth, 100 grand.
Do we take, do we take 2 times 12 times 30?
Yeah.
Okay, 64 times 12.
Times 12 times.
Yeah, I can't speak.
Decent enough. 90, probably about 92. That'd be scary in that thing. It is, because it's a step one way. It's going like. So low. I got all parts of the axle. I got the front end is freaking solid. I can like take my hand off the other.
Oh, no.
$500. Pretty sure she's got the same front end underneath under design does, except it's newer and electronic. All the guys.
What the heck?
Alright, gentlemen, let's get to work on homework.
I'm doing my homework. That's not using me.
No. It's not cheating, you did nothing wrong.
Okay. Okay.
So he on a pedigree with Amazon Prime.
That's creepy.
Like right here.
Jared.
What is that?
Yes.
Your camera.
Oh, grab that.
Why did you shit? I heard that too.